Good morning. Welcome to Traders Workshop, Options Brew TV. I'm Lex, your host. Low option volume this week, waiting for the Fed announcement, I think. But we've got some cool metrics today with the guys. Let's find out what we're getting into today. Good morning, boys. How are you? Mark, Jason, what's going on?
Good morning, Lex.
What's going on, Lex? How you doing?
I'm good. I don't know if you noticed my serape sort of look here. I'm getting ready to go to the mountains, so I'm going full serape. This just came in the mail. I can't even tell you about a bargain it was. We're going to talk about bargains and expensiveness with risk reversals today, so I wanted to lead off with a bargain. This is like the put and call being very similar. Okay.
I would have just called that a risky fashion choice.
It's a risky fashion choice. That is right. Jason. Now, we're going to get into Mark's metrics here shortly. And I think we're going to weave Jason in a little bit on some of these items here. But we're going to talk about risk reversals. Before I show the screen, though, Mark, can you explain what that means, the risk reversal, and then kind of talk about the other side of it, the collar? I call it a collar. It might be something different. So,
yeah, for sure. So the risk reversal strategy is a combination of a short call and long put, or short put and long call. And to the extent that you were to do it right at the money, that's going to just look like synthetic stock. But usually you pull that away a little bit. You do it at the 15 delta level, the 25 delta level, 2% out of the money, something a little bit away from the at the money point, so that you're selling a downside put to buy an upside call, or the reverse, which I think you'd refer to as a collar, where you would collar your traditional underlying position by selling that call and buying that put as a protective band within which stock can move, but above that price, you're flat. Below that price, you're protected.
Sure. What's the reason? Why would you do the risk reversal? What's the reason for that as an investor, or is there a reason?
I think a risk reversal makes kind of great synthetic delta play. That if you sell the 15 delta put to buy the 15 delta call, that's a synthetic 30 deltas that you're getting there. So it's a useful way to kind of get leverage out of an option strategy. And also you sort of capture some of that skew premium, which we'll talk about in just a second. But normally that put's going to be trading over that call, so you can have 30 deltas of exposure, whatever the net of your call and put are, in addition to a little bit of positive carry if you're short the put and long the call because of the price difference.
I gotcha. Okay, and you mentioned you like the 15 delta put and call, and I think you're going to show us a 25 delta as well. So 15 sounds about right. It might bleed into some of Jason's metrics in Vana and Charm. Hey, Mr. Charming, what do you think about that?
Well, assuming we're talking about a short put and a long call, which is, I guess you could say, the typical position of the option dealer, it is very positive Vana and very negative Charm. It kind of is like a bullish push for dealers. 15 delta, though, is right around the area where Vana has its most impact, and Charm has a high impact there as well, depending on how far away you are from expiration. So to be short that put is very beneficial, unless of course the market goes way against you and vol expands, then you can find yourself in trouble. So it's one of those things that you have to probably have a good stop in order to make sure that you don't blow up your account.
Right. So if that dealer is doing this trade that Mark described, so he or she short the downside put, long the upside call at the 15 delta, Vana at the put level, at the put strike, is long or short? Sorry.
Positive. Long.
It's positive, right? Okay, that makes sense. And it's negative on the other side, right?
No, it's positive too.
Oh, it's positive.
Vana.
Yep, you're right. Yep. Okay.
And Charm is negative on both sides.
So if down by the short put volatility goes higher, that put's going to go up in value, and the delta is going to go up, and that dealer's going to get longer. Is that correct?
Well, the dealers, and so they have to sell the hedge.
Yeah, sell the hedge. Okay, got it. All right, good. So, and Mark, back to you on this. So this isn't, it doesn't sound like it's a typical trade, the short put to long call for a retail person, because retail people tend to have long stocks and what have you, and would hedge those with the opposite of this, right? But we can glean information either way. You decide whether you're going to go long or short depending on cheapness or expensiveness relative to what we're going to see in a second, right?
Absolutely. And, I'd actually counter with that I do know some retail strategies, or I even run some retail strategies where you'd use part of your, like if you want to be long 100 shares of stock, if you only buy 70 shares of stock, keep the cash in a T-bill or something, earning 4.7% on a year right now.
Yep.
And you can then replace some of your deltas with this strategy. That's actually an interesting and does provide, an extra kind of boost of return. Doesn't need to be actively managed. I think the scenario where market drops, you see all your deltas go to the put. You really have to be delicate about managing that and constantly sort of rolling this. But I think it is, if you're on top of your trading, it's definitely something that's accessible for retail folks.
Good. Yeah. Okay. You want to take a look at this? Yep.
Yeah.
All right. Hold on. Let me pull it up. Can we see?
Yep.
Okay, you tell me, Mark. This is slide number. I'm calling it number 1. I downloaded them in some specific. Do you want to start here? Is this good?
Sure. Yeah. This is, we're looking at the calendar year 2022 and 2023 here. So we got 13 months of data going back here. And what I have plotted on the lower half of the chart, the below zero, is the cost of that risk reversal divided by the stock price. And so what percent of the stock price are you collecting by being short that put, long that call?
Okay.
Or what percent of stock price would you pay money out the door if you were to, collar that and buy the put and sell the call? And so I plot that against at the money vol on the top side to sort of show how skew, what this risk reversal really is measuring, or it's one measure of skew, relates to how vol movement changes. So they're related, but they're not always perfectly moving in tandem. That vol can go up and down, but skew can move like this also.
Okay, so let's make sure we understand. So if you have a flat skew, meaning the put and call at the 15 delta are the same price, we're going to get a zero number. Is that correct?
Correct. If perfectly flat skew, you sell the call for $1 and you buy the put for $1 also.
Right. Okay. And you're saying it's put minus call. Is that right? I just want to make sure the calculation.
Yeah. Sorry, I said that backwards, but you're correct.
Yep.
This is not. Yep.
Okay. So put minus call 0 divided by the stock price, still going to be 0, right? Dividing by the numerator is 0. You're going to get 0. So we don't see any of that ever here in these things. So you never hit 0, but you do get close. Whatever the state is. Can you see my mouse?
I can't particularly well, to be honest.
Okay.
Not right now.
You can't? Okay. Sorry. It doesn't come up. Okay. So I'm looking in between July and October, right in the middle, where we have that spike towards 0. And then we have a lower at the money vol above. So what I'm going to get at is that typical implied volatility at the money coming, it looks like it's coming down, right? In this little trough here between July and October, which causes this risk reversal to go towards 0. Is that natural, or am I just not reading this very well?
I think generally when vol rises, skew steepens.
Okay.
And so I think what you're looking at, that specific range, is that August rally that we had last year, where vol really started trickling down, skew started to flatten. But they can move independently too. For example, in October, vol kept rising, but I think skew was staying choppier even as vol first starts to come in. So skew is an expression of how much people think things are going to move on that fat tail, that sort of kurtosis of the distribution.
Sure.
Where money vol is just general variance. So very related, but not, lockstep.
Right. Now, for your purposes, Mark, when this relationship is there a number that it starts to become interesting? Like, I see there's not very many occurrences below the negative 50%, or so I see a few early in the graph, but that's about it. So do you like to get into this trade at special spots here, 50% or lower, or not really?
like those are some of the scariest times in the market, right? Like if you start seeing, and this is in SPY, SPX looks nearly identical to this. But when you start seeing those 50 basis points readings here, like that's a scary time to get short those puts. Now, usually it does rebound and whatnot. But I will note that this is looking at a constant figure. So this is not necessarily tracking a specific risk reversal and whether you would have made money on that risk reversal. This is tracking the constant 30-day risk reversal. It's kind of like the VIX, right? Like you can't buy the VIX.
Yeah. Okay, got it. Okay, cool. And then just for some nomenclature, at the money, we know, I think Falk is a falcon. You name things after birds, which is
yeah.
good.
You've gotten a little insight into my variable and strategy naming here. So I do call my risk reversal strategy the falcon strategy.
So we're big into birds. We talk about seagulls and we talk about iron condors and butterflies, things that fly. We're into, right?
Oh yeah.
Okay. 1530 means 15 delta call put. 30 is 30 days.
Bingo.
Then you overlay 25 delta call put with 30-day as well. Jason, 15 versus 25, where does it hit the Vana man? Is one more Vana than the other? Or are they both?
I mean, it's probably both close to the same. 20 is usually the absolute peak.
Yeah.
But 15, I mean, you have to get some significant movement in the underlying to make it Vana and charm intense.
You guys should get together and create a template with his stuff and your stuff. And now we have this whole falcon thing with the Vana man. You know what I'm saying?
We might have to work on the naming, but I mean, I think in general, like the reason 15 delta is selected here is exactly what Jason's saying, right? That you get a lot of support at that level.
Yeah.
Now, of course, it can blow through. Of course, like macro news can shift, and that's not the whole story. But that 15 delta area does act as a decent support there. And so being short that put, assuming you got enough margin, like that's a nice, level to set it at because of exactly the dynamic Jason described.
Sure. And you said before why a retail person would do this, because remember, we're in our example, we're getting short the put to be long the call. So we're getting short deltas on this one, right? So it's a good strategy.
Long deltas.
I'm sorry, getting long deltas. My
very
bad.
Long deltas.
We're buying the put, buying the call, selling the put. We're getting long deltas. So why would someone in the retail world do this? Would it be against another part of the portfolio? Because they're always long stocks anyway, right?
As like a stock replacement strategy, I think it makes sense, right? Like a delta replacement strategy.
Yep. Okay, that's what I wanted to hear.
It's more like you're buying upside gamma for downside gamma. Like you're sacrificing the downside strong move because you're anticipating more of an upside strong move, and you're going to make more that way instead of just buying stock.
But think about it too, right? So if this thing lays up where it's really expensive to do this, you would rather do that in replacement of stock, I think, because you're getting paid for it, right? So if you're getting edge to do this in terms of steepness, and you want to be long, okay, that's got to go into the situation. You would rather have edge to get this, right? Stock has very little edge, if any. It's zero.
Right.
Whereas options have edge to them. So this would be a great stock replacement strategy, in my opinion.
Yeah, I mean, I think the real only caveat to this is that it does require active management, right?
Yes.
And you're not always going to, you buy 100 shares of stock, you're always long 100 deltas. Exactly, SPY goes up $1, you make $100. Whereas with the options, of course, they're moving in other dimensions. You need to roll this. So usually the way I'll set it is I'll set a bound, right? That if this 30 delta wavers between 25 and 35, I don't necessarily restrike anything. You start to go outside of that, then you need to rehedge, and then I'll also roll it weekly. Just so you're kind of constantly keeping in that 30 delta and kind of dazed expiration mode too.
Perfect. Okay, good. Let's go to slide number 2.
I was about to say, looking now at this chart, it seems now's a good time to put on a collar, a fully hedged collar.
I actually very much agree. And when we were talking about this a day or two ago, I went out and bought a one lot because I was so convinced by my analysis here.
So the collar is the opposite of the risk reversal. The reason Jason's saying that is because we're nearer zero out here. So the call and put are getting closer to value. So that's
it's not exactly the opposite of it's not the opposite of a risk reversal. It's a risk reversal that is fully hedged by stock. So you have stock involved if there's a collar.
You could not have stock. You could not say I'm just.
But then it's a then it's a bearish risk reversal.
No, you can't say that. You can't say that. Don't be saying risk reversal for a long put short call. That breaks the brotherhood.
That's a falcon.
That's a seagull. All right, let's go to slide number 2.
No, seagull's something else. Don't be confusing your bird names.
That's right.
It's an osprey.
It's an osprey.
Oh,
all right, Mark, this is slide number 2. So we've got risk versus at the money vol versus stock price. Now, tell us what's going on here.
This just cleans it up a little bit and shows it in a different dimension. Still that, stock price relative to at the money vol, like that's a pretty common thing that people are used to seeing, right? Like this might as well be VIX versus SPX, that vol goes up, stock goes down. But this probably shows a little cleaner sort of the alternative dimension that also exists for skew.
Yeah.
And I think to Jason's point about it's getting to a level that it's relatively cheap. Like, I think combining some of the macro analysis that you could be making, the events that are out there, right? Like if we have a bunch of these, potential catalysts like earnings, GDP, name your macro indicator, FOMC minutes, to the extent that that risk reversal is relatively cheap, like that makes an interesting play, on a significant market move to the downside.
Yeah.
Because that's really going to explode, if there is that.
That's a good point. Because here's what I'm looking at. As you're talking, again, I don't know if you can see my mouse, but I'm looking at 4/1 of 2022, that line. So we have a kind of this index top here, and look where our risk reversal is. That's kind of a top or a bottom, however you want to look at it, right? So these peaks in the risk reversal seem to like predict a little bit of the next market move to the downside. They're pretty good too. If you look at them, right? Pretty interesting. So this on just before 4/1 of 22, you've got a peak on the risk reversal, and look where that market is in the underlying stock. And then what happens after that? It goes all the way down, right?
So it's like if things are always darkest before the dawn, things are always calmest before the storm.
Yeah, it kind of looks like that, right? That's interesting.
Yeah, but I would say that the peaks are caused more by the drop in the stock price than the other way around. I think it's more reactive. And the other thing too is I wouldn't necessarily use this as an indicator because as you could see in July or after October, you don't know where that peak is going to happen. You saw a little peak there right before July 1st, and it only was a head fake and just kind of stayed level.
Yeah.
So I think I wouldn't use it as an indicator, though. You kind of were going in that direction.
Oh, I listen. I want to see your cards before I get dealt my cards. Okay, always. I want indicators. I'm trying to look for the world's best indicator. I like this one. This is good. This is cool. Okay, good. I know we're running a little light on time. Anything else here, Mark, for now with the Falcon?
No. I think we can quickly take a look at the last one. This just extends it to a longer time horizon, and you see that COVID panic, right? Like I think that's one of the we know what vol did at that time, but just like the kurtosis of how steep that downside really gets bid when you think the world is ending.
Yeah, that's a big daddy. Okay, wow.
And it represents very much a paradigm shift, right? Between like pre-March of 2020 versus post-March of 2020. We haven't quite even recovered back to like kind of the lull that existed before that. And
I agree with that.
You're seeing a little more choppiness even in that pricing over the last 2 or 3 years. That's a real fissure.
It is for sure. But again, we're getting back toward the happy zone at the end here a little bit. Let me see. I want to see this last one. Hold on a second. Okay. Well, not quite, but interesting. All right, Mark, I like this stuff. Hold on, let me get us out of here. No, that's really cool stuff. So you use that actively for your trading and
definitely, like I was saying, it's like a stock replacement. It's an interesting way to get access to that skew premium, really.
Yeah. I love
And
it.
I really like Jason's framing too of the negative gamma that you're trading for your positive up gamma. I think that's an interesting way of like express, because options give you convexity, right? Like it's very different than just having 30 other hard deltas.
Yeah. Just think you could be like a dealer too. You can have the short put to have the long call. You just like a dealer if you wanted to
Just
be.
like a dealer. That needs to be my tagline for this.
You got to have just be like the dealers, right? But they won't trade it like a dealer when it gets
Without
down to
hedging.
short gamma. Yeah, don't hedge it. Don't hedge it.
Unhedged dealer.
Unhedged dealer, exactly right. All right, good man. That was great. What do we have? What are we hoping for here at the Fed? So there's an announcement coming up when? Tomorrow? What day is it today? Today's Thursday. My God,
No, it's next week.
Next week. So it seems like option volume has subsided a bit, relatively speaking. I think people are sort of waiting for that number, right? Or am I missing something? Because volume's definitely down, according to what we're seeing.
This week does feel a little slower. I mean, obviously, going into January Expo was a huge print. OCC did 45 or 50 on Friday, but the last 2 days have been relatively lighter.
Yeah, that's what I mean. The last couple
of
days of.
You guys are forgetting it's Lunar New Year. The whole Chinese market is closed. The whole week.
You're right about that. I have a Chinese friend who has celebrated the New Year. You're right. That is absolutely true. It seems like a week-long celebration or something like that. Or maybe
It is a
month.
week-long celebration. Yeah,
That's
the markets
pretty good.
are closed the whole week.
And
Everybody's
then
off.
there's
Everybody travels.
That's right. And then there's like a meteor or comet that's going by the southern tip of South America. That's not going to hurt us, but it's closer than normal. Did you hear about that? That can cause skew to go higher.
I was going to say that if there's an indicator, I'd say meteors approaching Earth is about as strong as you can get.
That's right. I don't know.
The solar flare indicator.
I don't know if I would fade the meteor approaching Earth. I might not be around to collect my winnings.
Well, it's like the O'Hare straddle.
Oh,
It's
yeah, right.
the meteor skew trade, the meteor risk reversal.
Yeah. Oh, brother. All right, boys. It's the top of the hour. Thanks. That was really good, Mark and Jason. Very good. Very good. We're out next week. It's a snow day, so we'll catch up in 2 weeks. You guys have a good weekend, and we will talk soon and see you afterwards. How's that sound?
Happy trading.
All right. By the way, I didn't even comment on Jason's earphones and Mark's cool sport coat. He's going to a wine tasting, I'm sure. Look at that
I
wine.
even got myself a new microphone.
May or may not be true.
May or may not be true. All right, we'll chat. Good to see you guys.